Hello, I'm Michael Hainsworth. Is Canada financing the AI arms race? Artificial intelligence is changing our bond market. We've just had two of the biggest players in the space issue more than $22 billion worth of paper. Bond guru Domenic Bellissimo sees opportunity, but Canadian investors need to get smarter. My worry with large American multinational AI-related companies coming to Canada to get their funding for these projects is that Canadians will end up holding the bag for the failures, not the winners, but the losers within the group. So what's the one thing that an investor today needs to know about the fixed income component to their portfolio as it relates to this world?
I think all investors need to spend the time to understand how active their fixed income managers are. So understanding the work that's going into analyzing and assessing the credit risks, how willing they are to maneuver interest rate risk within the portfolios, and then ultimately having a greater appreciation for the underlying dynamics and the approach that the manager is taking rather than just saying, I have AI exposure.
Coming up, we'll find out what the Americanization of the Canadian corporate bond market means for your portfolio and what it would take for Dom to buy into the hype. But first, when we talk about investing, we often focus on where to buy: stocks, bonds, ETFs. But there's a second decision that investors usually overlook. It's where to hold those investments. Because taxes don't just reduce your returns, they compound against you over time. So let's break it down. First, the tax-free savings account, the TFSA. That's your most valuable box. Growth assets belong in it. We're talking equities, high-return investments, because every dollar of growth is yours to keep. You don't pay taxes on your gains. But your RRSP, that's tax-deferred, not tax-free. You'll pay tax when you withdraw, and because it's typically done when you retire, you'll likely be taxed at a lower rate than when you were working. So this is often where income-generating assets live: bonds, dividend companies. And then there's the taxable account. This is where tax efficiency matters the most. Canadian dividends get favorable treatment. Capital gains are only partially taxed, so we place assets accordingly. Same portfolio, different structure, better outcome. This is called asset location, and it's one of the simplest ways to improve after-tax returns without taking more risk, because great investing isn't just about what you earn, it's about what you keep. You know, Dom, Amazon had that $14 billion offering after Alphabet came out with that $8.5 billion deal. What does this enormous demand for these issues tell us about the depth of the Canadian market and ultimately, I suppose, about the appetite of Canadian institutions for global corporate debt?
I guess what that will tell you is when you have a high quality issuer entering the market and actually for the first time, that demand can be very high and robust. So investors were aware that this was likely to happen. They were positioned to allocate significant sums. What we also saw, and which was interesting, is that there was an allocation away from provincial bonds, in some cases, to move into these two issuers being higher quality. So you have, in a way, a perfect storm where you had high quality issuers that are not new to the market. There is effectively no technology exposure in the Canadian corporate credit market, very small. So if anyone wants to gain access to it, this is one quick way to do it. And then you also have index inclusion, and so that'll draw more demand.
This has been described, though, by you as the Americanization of the Canadian corporate bond market. What's changed? Why has this transformation accelerated?
So if you think about the world following the global financial crisis, so 2009 thereafter, the amount of demand for corporate credit has grown exponentially. And following the GFC, so the financial crisis, we had more companies accessing the bond market globally. So banks were cutting back on their lending, and what was a traditional source of financing, that being the bank balance sheets, became curtailed, and companies were then encouraged to go into the public markets. So we had more issuers. You also had an increase in the amount of foreign issuers accessing or trying to access the Canadian market. And that brought with it more issuers, broader credit market dynamics in terms of credit ratings, a growth in areas like high yield, so the high yield issuers, investment grade for sure. And so you ended up with a broader market, far deeper than you would have had prior to the global financial crisis.
You mentioned that these bonds are also, on the indexes now, and I can imagine that makes it a heck of a lot easier for Canadian dollar bonds issued by foreign companies to become part of an investable benchmark. How important to you is index eligibility when it comes to making a decision about a buy or a sell or a hold?
At the beginning of 2025, bonds issued by foreign corporations were allowed to enter the index, the Canadian index. And in doing so, it naturally attracts all Canadian investors into that particular bond. So passive investors, for example, that are aiming to match the index, well, they would be natural buyers of all bonds that enter the index. So that increases the demand. For investors like ourselves that are active and have an active slant, it does help having index inclusion to a degree in that it broadens out the universe of potential, buyers. But at the same time, it's not necessarily a prerequisite. And so there's a bit of give and take. It increases the number of buyers in the market, which is a good thing. But it can also have a dampening effect on valuations in that more buyers, more demand might actually compress what credit spreads are.
Everyone I've talked to has suggested that we're expecting a much wider range of international issuers to enter Canada over the next few years or so. How does that complicate our investment decisions?
So if you think about the world when you have more issuers and greater variability, it does make it more complicated for investors having to know more names, more industries. That said, you also have to have a greater sense and understanding of what's happening in foreign markets. So it's important that you are following the goings on in places like the US to a greater degree. And in doing so, having an understanding of what's going on in those markets and whether or not that is likely to impact the Canadian market. So if you think about the Canadian market, and I go back to the global financial crisis, it was much more an island unto itself. Canadian issuers, much more Canadian investor base. Today, it's far more international. So foreign investors are stepping in more so today than any time in the past. That is likely to continue to grow. And foreign issuers are likely to continue to access the Canadian market more. So it gets caught up in what is happening in non-Canadian markets.
More issuers means more diversification, but counting corporate names doesn't guarantee it. And a combination of AI valuations, U.S. monetary policy, and global risk appetite risks leaving Canadians financing America at our own expense. Plus, there's no way this boom isn't going to bust somehow, right? I want to confront the bubble question directly. What makes today's AI investment boom different fundamentally from the technology bubble we saw burst in 99-2000?
The first thing that stands out to me is that the companies underpinning a lot of the growth today, so we'll call the hyperscalers, for example, Amazon, the Googles, the Metas, Microsofts, they're very real companies. They are behemoths. They dominate their respective areas, industries, and they have a huge amount of free cash flow, at least entering this period. So this is unlike what we saw for a good portion of the dot-com bubble and growth in the late 90s, where many of these companies were smaller, startup, and didn't have the financial strength that the companies today are demonstrating.
So then let's flip this to the other side. What are the similarities to what we saw in 99-2000 with the dot-com bust that should make investors uncomfortable?
So if you think about AI, artificial intelligence, it is a transformative technology, I believe, and many do. And so that looking forward, it will have a huge impact on all of our lives, not unlike what the internet has done for our lives. Now, the growth has been significant thus far and will likely continue to be significant. So it can feel, even though we're in the early stages, like you have a massive ramp up. So from that perspective, there is an internet, bubble type discussion. Other concerns would be that you are likely to have, and you will have, winners and losers. So not every company that's getting involved will succeed, and some might not succeed as well as others. So we really don't know how well these companies will be able to monetize their AI investments. So they spend a lot on CapEx. How much will they earn? What can they actually charge? So it's still in the early days in that respect. So there are a lot of questions looking forward. And so when you factor the uncertainty tied to their business models, notwithstanding the strength and underlying financial strength of those companies investing, there's just a natural uncertainty. And if I may, one other thing that I could put out is, and it gets talked about a lot, is a circular financing. So a company that is guaranteeing a client to then invest in the products that they're selling. I understand what they're doing. It makes a lot of sense in many cases, but it does pose questions. So if there's a break in the chain, what does this mean ultimately?
That chain is ultimately going to break. To your point, there will be winners and there will be losers, just like we saw with 1999 or so. And so this is why I want to talk to you particularly, because if one wants to make an investment bet on artificial intelligence, and to your point, that makes it different from the last time, is that most of the major players are large organizations with deep pockets, as opposed to dot-com startups who managed to IPO and blow all that cash. There will be significant losers. And that circular nature of some of that financing for things like GPUs and stuff like that, at some point the chickens have to come home to roost.
So if you think about how large AI will be, and then what these companies I mentioned earlier, how will they be able to monetize and what can they charge? As AI grows and becomes profitable, presumably, then all these companies tied to it will grow, and a rising tide will lift all boats. If, however, there is some sort of break in the business model or the expectations, or just the degree in which these companies can actually charge, let's say, for example, for their AI platforms, and the degree of usage from either retail or corporate issuers, if it doesn't meet expectations, then at that point you could see a greater degree of uncertainty and working its way into the market.
Which is why I'd rather be in the bond market than holding these stocks.
So look, I'm talking my book here. So being a bond investor, but when you think about what's happened with yields since 2022 and 2020 and how they spiked in 22, and they're still elevated levels, and we believe they'll remain in elevated levels going forward. And then you've got a lot of supply today and into the future. The two will, we believe, when you combine it, you see wider credit spreads on higher quality companies and higher baseline yields on the government yields. Combined, you're actually able to generate a yield to maturity on high quality bonds, high quality companies that are north of 5%, 6% even, in some cases 7%, depending on the term. And we think it does provide a really unique opportunity for investors to diversify their holdings, be higher up on the capital stack, still be involved in the AI play with companies that are still very profitable, and we believe make a lot of sense on the longer term, and that will ultimately be winners as AI makes its way through society on a global basis.
My worry with large American multinational AI-related companies coming to Canada to get their funding for these projects is that Canadians will end up holding the bag for the failures, not the winners, but the losers within the group. So what's the one thing that an investor today needs to know about the fixed income component to their portfolio as it relates to this world?
I think all investors need to spend the time to understand how active their fixed income managers are. So understanding the work that's going into analyzing and assessing the credit risks, how willing they are to maneuver interest rate risk within the portfolios, and then ultimately having a greater appreciation for the underlying dynamics and the approach that the manager is taking rather than just saying, I have AI exposure.
So our bond investment decisions get a little more complicated now that the landscape isn't dominated by pipelines, banks, and Ma Bell. American issuers are bringing new sectors to Canadians. But are they also bringing U.S.-style volatility north of the border? Because there's one thing this bond investor knows: owning a great company doesn't necessarily mean owning a great bond. Your point about having to stay on top of all these new issues that are going to be coming out over the next few years or so, yeah, I think we need to focus a little bit more on that. You say that investors are going to need visibility to the U.S. Market to navigate this change, but what does that mean in practical terms? What information can a manager see in the U.S. market that a Canada-only investor might miss?
The U.S. market is significantly larger than that of Canada, so that shouldn't be a surprise. If you think about what a corporate bond investor needs to stay on top of to have a better sense of what could happen in Canada, so things like supply, understanding the day-to-day supply dynamics and even what the expected future supply dynamics will be, that is huge. Because companies will issue in markets that they feel is advantageous for themselves, and those supply dynamics will ultimately impact all markets to varying degrees. You need to understand relative value, and you need to be, and this is important, you need to understand where things are priced and whether or not what is being issued in Canada is a fair price relative to where it could be issued and could be trading in places like the United States.
See, you brought up a very interesting concern that I have, that the Americanization of our market will import U.S.-level volatility, but not U.S.-level liquidity. So if we did see a market shock, are we concerned that these bonds could be repriced quickly, more so than their American counterparts, but at the same time remain harder or more expensive to trade?
If you think about what has happened historically, the Canadian market has always been less volatile than that of the US market. So sell-offs have not been as deep, but rallies have also not been as aggressive. And so what I think investors should expect in the corporate market in Canada is as you become more American-like, so more issuers and a greater influence from everything happening south of the border, valuations and supply and all those things, that those dynamics will leak into the Canadian market. So we should expect a greater degree of volatility going forward. And it won't happen all at once. It'll be graduated over time. So you bring up an interesting point about liquidity, and liquidity will be a tough thing to gauge because I think you'll have bouts of illiquidity in the Canadian market that historically hasn't been quite the norm. But I think it could take time for that to eventually play out. As the market grows, the breadth of the market grows, and you have a greater number of issuers, even lower quality issuers. So either more high yield or low triple Bs. So what you'll see is the dynamics in the market switching from a higher quality, perceived safer market to something that is far more likely to show a greater degree of volatility over time.
Credit spreads have been exceptionally compressed, while Canadian corporate issuances have risen sharply. So Canadian corporate supply reached, what, $85 billion just by the end of the spring here. That's, what, 55% more than it was at the same time last year. So where are you finding genuinely relatively valued bond opportunities? What persuades you to pass on a bond from a company such as an Amazon or an Alphabet?
If you think about where we're finding pockets of value, the front end to us still does hold attractive value overall, in part because you get the benefit of things like the roll down, higher break-even levels. So that would be one. I think also it's important for investors to keep in mind, and one thing that we're focused on is to look at different groups or cohorts of issuers and determine where within that entire cohort you see greater degree of value. So there are times, and you take a look at the banks, for example, where they would trade within a certain range, and you might have a higher quality or a lower quality institution, but they'll trade within ranges and bands. Now, it's not uncommon for any one of those to, over time, have an excursion in valuation. So perhaps becoming more expensive, or we'll say cheaper, and show greater relative value. And that could be because of idiosyncratic concerns. It could be because supply from that one particular issuer, number of reasons. So what we're aiming to do as part of our overall process is to look at different cohorts we think represent good value, and then where within that should we be spending and allocating our capital. So it's important to consider that not every company is worth owning at all the time, and that you really have to allocate thoughtfully to where you think within that bucket of issuers that you can get the greatest value. And let's just be clear, it doesn't always have to be the cheapest issue. It could be that it's a company that you think is of higher quality that is trading in line with other lower quality issuers, and perhaps it's more of a defensive play, for example. So it's important to look at each of these different areas of focus, and then to distill which within each of those where it makes the most sense to allocate.
Never mind artificial intelligence. I'm still waiting for people to tell me that the internet is a fad and it's failed. Thank you so much for your time and your insight.
Thank you, Michael.
The Canadian corporate bond market is becoming larger, more global, and more important. For investors, that means access to more sectors, more highly rated companies, and a broader opportunity set. But it also means more volatility, more complicated valuations, and greater exposure to forces outside of Canada. The AI build-out illustrates both sides of that equation. Companies such as Amazon and Alphabet are profitable, established businesses investing in technology that could transform the global economy. But the size of their capital commitments and the uncertainty surrounding how those investments get monetized means credit quality can't be the only consideration. More opportunity brings greater risk, requires more research, and a willingness to sit on the sidelines while the cheerleaders jump at every goal. Now you're on the money. I'm Michael Hainsworth. Thanks for joining us.